Topic: the indirect method for cash flows from operating activities. A company reported net income of $50 million. It also reported $8 million in depreciation expense. During the year, accounts receivable increased by $6 million, inventory decreased by $4 million, and accounts payable increased by $3 million. The total net adjustment to net income to determine cash flow from operations is: A. Add $9 million. B. Add $15 million. C. Subtract $5 million. When using the indirect method to calculate cash flow from operations, which of the following would be added to net income? A. An increase in prepaid expenses. B. A decrease in income taxes payable. C. Amortization of a patent. An analyst gathered the following data for a company in millions. Retained earnings increased by $18. Cash dividends paid were $6. Depreciation expense was $20. Accounts receivable increased by $4. Inventory decreased by $3. Accounts payable decreased by $5. The company's cash flow from operations is closest to: I. $26. B. $32. C. $38. A company reported net income of $80 million and depreciation expense of $10 million. During the year, accounts receivable decreased by $6 million, inventory increased by $8 million, and accounts payable increased by $4 million. The total net adjustment to net income to determine operating cash flow is: A. Add $90 million. B. Add $12 million. C. Add $16 million. An analyst gathers the following information about a company. Net income $450 million. Decrease in accounts receivable $30 million. Increase in inventory $25 million. Decrease in accounts payable $15 million. Based only on this information, the net cash provided by operating activities in $ millions is closest to: A. 410. B. 440. C. 490. Operating cash flow using the indirect method is calculated as net income minus income, gain, assets, plus expense, loss, liabilities. Non-cash income, gains, and assets are deducted from net income, while non-cash expenses, losses, and liabilities are added. Operating cash flow is calculated by adjusting net income for changes in working capital and non-cash expenses. The total net adjustment in this case is $9 million. Operating cash flow is calculated by adjusting net income for non-cash items and changes in current operating assets and liabilities. Amortization, a non-cash expense like depreciation, reduces net income but doesn't involve cash outflow. It's added back to net income to reconcile to cash flow from operations using the indirect method. Additions to net income: non-cash expenses and non-operating losses. Non-cash expenses: depreciation, amortization, impairment losses, stock-based compensation, and unrealized losses. Non-operating losses: losses from asset sales, write-downs, debt retirement, and equity method investments. Operating liabilities changes: accounts payable and accrued expenses, salaries, interest, income tax. Operating assets changes: accounts receivable, inventory, and prepaid expenses. Non-cash items adjusted: amortization of bond premium, unrealized gains, gain on asset sale, gain on debt retirement, and income on investment under the equity method. Changes indicate differences between current and previous periods. Net income is $24 million, with changes in operating assets and liabilities impacting cash flow. Operating cash flow is calculated by adjusting net income for non-cash items, gains, losses, and changes in current operating assets and liabilities. Operating assets decreased by $6 million due to accounts receivable, while operating liabilities increased by $14 million due to inventory, accounts payable, and depreciation. Operating cash flow is calculated by adjusting net income for non-cash items and changes in current operating assets and liabilities. Operating cash flow using indirect method. Operating cash flow equals net income minus all inflows and assets plus all outflows and liabilities. The exact formula operating cash flow equals net income minus non-cash income minus non-operating gain minus changes in current operating assets plus non-cash expense plus non-operating loss plus changes in current operating liabilities. Topic: Cash flows from investing activities. A company reported a gain on the sale of machinery of $5 million. The income statement also shows depreciation expense of $10 million. The cash flow statement reports capital expenditures of $25 million. The net increase in the gross PP and the account was $8 million, and the net increase in accumulated depreciation was $7 million. The cash proceeds the company received from the sale of machinery is closest to A. $25 million, B. $21 million, C. $19 million. A company reported a loss on the sale of equipment of $3 million. During the year, depreciation expense was $12 million and capital expenditures were $20 million. The gross equipment account increased by $4 million, and the accumulated depreciation account increased by $8 million. The cash received from the sale of equipment was closest to A. $1 million, B. $9 million, C. $17 million. A company purchases a new delivery truck for $60,000 cash. The truck has an estimated useful life of 5 years and no salvage value. Ignoring taxes, what is the immediate impact of this transaction on the company's financial statements? A. Operating cash flow decreases by $60,000. B. Investing cash flow decreases by $60,000 and depreciation expense increases by $12,000. C. Investing cash flow decreases by $60,000. Historical cost of equipment sold equals beginning balance equipment from balance sheet plus equipment purchased from informational note minus ending balance equipment from balance sheet. Accumulated depreciation on sold equipment equals beginning balance plus depreciation expense minus ending balance. Book value of equipment equals historical cost minus accumulated depreciation. Cash from equipment sale equals book value plus gain loss. Equipment sold's historical cost is calculated using beginning and ending equipment balances and equipment purchased. Accumulated depreciation on sold equipment equals beginning balance plus depreciation expense minus ending balance. Book value of equipment equals historical cost minus accumulated depreciation. Cash from equipment sale equals book value plus gain loss. The purchase of a delivery truck is an investing activity, reducing investing cash flow by $60,000. Depreciation, recorded over the asset's useful life, does not impact cash flow at purchase. A. Incorrect. Incorrectly classifies purchase as operating activity. Operating cash flow unaffected by capital expenditures. B. Incorrect. Investing cash flow impact is correct, but depreciation expense is incorrectly stated to increase immediately. Topic: Cash flows from financing activities. A company reported net income of $50 million. The following changes in shareholders' equity occurred during the year. Common stock increased by $5 million. Additional paid-in capital increased by $15 million. Retained earnings increased by $30 million. Based on this information, the financing section of the cash flow statement should report a issuance of stock of $20 million and dividends paid of $20 million. B issuance of stock of $20 million and dividends paid of $30 million. C issuance of stock of $30 million and dividends paid of $20 million. Stock issuance increased common stock by $5 million and additional paid-in capital by $15 million, resulting in a total cash inflow of $20 million. Dividends paid are calculated by subtracting the change in retained earnings from net income, not by using the change in retained earnings alone. Topic: differences in cash flow statements prepared under US GAAP versus IFRS. Under US GAAP, which of the following cash flows is most likely to be classified as an operating activity? A. Cash received from the sale of a factory building. B. Cash paid to acquire a 30% ownership stake in a supplier. C. Cash received as interest on a corporate bond investment. According to US GAAP, the receipt of dividends from an equity investment is classified as a cash flow from A. Operating activities. B. Investing activities. C. Financing activities. A key similarity between the statement of cash flows under US GAAP and IFRS is that both require A. Interest paid to be classified as an operating activity. B. The direct method for presenting operating cash flows. C. Separate disclosure of cash flows from income taxes. A company using IFRS classifies interest received from investments as an investing activity. If the company were to report under US GAAP instead, the most likely effect would be A. Lower cash flow from operations. B. Lower cash flow from investing activities. C. Higher cash flow from financing activities. Under IFRS, dividends paid by a company to its own shareholders are least likely to be classified as A. Financing activity. B. Operating activity. C. Investing activity. A company's cash flow statement shows cash paid to suppliers as a line item under operating activities and classifies interest paid as a financing activity. This presentation is A. Permitted only under US GAAP. B. Permitted only under IFRS. C. Not permitted under either IFRS or US GAAP. A company reporting under IFRS must decide how to classify cash flows from interest and dividends. Which of the following classifications is permissible under IFRS? A. Classifying dividends received as an operating activity. B. Classifying interest paid as an investing activity. C. Classifying interest received as a financing activity. Which of the following statements regarding cash flow statement preparation is most accurate? A. Under US GAAP, a company can choose to classify dividends paid as either an operating or financing activity. B. Under IFRS, a company can choose to classify interest received as either an operating or an investing activity. C. Under IFRS, a company can choose to classify taxes paid as either an operating or a financing activity. On July 1st, a company issues a one-year, $100,000 note, payable with 8% annual interest. The principal and all accrued interest are paid in full at maturity. When the company makes the final payment on the following July 1st, the cash flow statement under US GAAP will report A. $108,000 outflow from financing activities. B. A $100,000 outflow from financing activities and an $8,000 outflow from operating activities. C. An $8,000 outflow from operating activities and a $100,000 outflow from investing activities. Interest received from investments is classified as an operating activity under US GAAP. A. Incorrect. Sale of factory building, a long-term asset, is an investing activity. B. Incorrect. Equity investment is a 30% ownership stake. US GAAP classifies dividends from equity investments as operating activities due to their impact on net income. B. Incorrect. Investing activities involve cash flows from acquiring and disposing of long-term assets and investments, excluding dividend receipts. C. Incorrect. Financing activities involve cash flows from transactions with owners and creditors, including issuing or repurchasing stock, paying dividends, and borrowing or repaying debt. US GAAP and IFRS require separate disclosure of cash flows related to income taxes, enhancing transparency and understanding of tax impacts on cash flows. A. Incorrect. Interest paid classification differs between US GAAP and IFRS. B. Incorrect. US GAAP and IFRS allow companies to choose between the direct and indirect methods for presenting operating cash flows, with the indirect method being more commonly used. Interest received, currently classified as investing cash flow under IFRS, would be classified as operating cash flow under US GAAP, resulting in lower investing and higher operating cash flow. A. Incorrect. Cash flow from operations would be higher under US GAAP due to interest received being added to operating activities. C. Incorrect. Interest received classification impacts operating and investing activities, not financing activities. Dividends paid are not investing activities under IFRS, as they represent profit distribution, not asset acquisition or disposal. A. Incorrect. Dividends paid are classified as financing activities under IFRS, representing a return of capital to shareholders. B. Incorrect. IFRS allows dividends paid to be classified as operating activities if closely related to core business operations, though this is uncommon. Cash paid to suppliers is an operating activity under both IFRS and US GAAP. However, only IFRS allows companies to classify interest paid as a financing activity. A. Incorrect. US GAAP mandates interest paid be classified as an operating activity, not a financing activity. C. Incorrect. The presentation of interest paid as a financing activity is permitted under IFRS, contrary to the incorrect claim in the option. IFRS allows companies to classify dividends received as operating or investing activities, with operating being permissible. B. Incorrect. Interest paid is classified as operating or financing activity under IFRS, not investing activity. C. Incorrect. Interest received can only be classified as operating or investing activity under IFRS, not financing activity. IFRS IS 7 allows companies to classify interest received as either an operating or investing activity, reflecting a principle-based approach. A. Incorrect. US GAAP classifies dividends paid as financing activities, reflecting its rule-based approach. C. Incorrect. Under IFRS, taxes are generally operating activities, with limited exceptions for investing or financing activities. US GAAP requires separate classification of principal and interest payments on the cash flow statement. Principal repayments are financing activities, while interest payments are operating activities. A. Incorrect. Interest payments should be reported under operating activities, not financing, according to US GAAP. C. Incorrect. Principal repayment misclassified as investing activity.